Good evening. Welcome everyone to Admiral Markets webinar. Today, of course, is the Pro Learning Lab webinar focused on an educational topic. And today's focus is on effective methods trading supply and demand and those zones. This is the 15th September. We're going to dive into that topic in just a second. First of all, this risk disclaimer explaining the fact that the webinar and later on recording is shown to a global audience. It may not be suitable for everyone, though. Please take a look at admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity for more details. Also, please be aware that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, folks, thank you so much for your attention on that. Nenad and I are going to be hosting this webinar, and I will first of all share my views and then pass it on to Nenad. First of all, where is basically the supply and demand zone? A bit of a question, first of all, as we kick off this webinar for you. Within this particular chart, where do you think that the supply and demand zone is located? I know that may be a bit difficult to give you a reference point. Perhaps you can use the dates at the bottom. Just tell me what date you think that it starts, perhaps, and we'll discuss that if that's the correct answer. So what is, or where is the supply and demand zone? Is there one at all? Is it a trick question? Let's see who knows something about supply and demand zones, first of all. This is something that we definitely took a look at in the past in live webinars as well. I remember probably 6 to 12 months ago we did that a couple of times. And I still use them. When I see them, I mostly talk about them. All right. So we got some couple of answers. First of all, September 6th at 14, which is basically here. Let's see, there are several of them. Supply around 131.60, 113.60 probably. 113.60 is up in here, and 112.50. So it basically, there are multiple ways of looking at it as well, and I'm going to show you one way. Now that might show a different way. So that depends, and what I'm going to show you is not the answer to everything, is not the only unique answer possible. But indeed, basically, depending on how you look at it, supply and demand is where price is basically going sideways, as basically supply and demand are roughly equal, or there's no less liquidity. In any case, basically, price moves up, hits a level of resistance, let's say, or moves down, it hits a level of support, and it cannot break away from that zone. So that's what I call, at least, a supply-demand zone, when a relatively tight support and resistance are near each other and price is going sideways. In this case, that would be this particular field right in here. So I marked that in the next one, and you can see that box basically indicating what I would consider that supply-demand zone. All right. Now, some of you make the case, okay, but how about one answer was pointing to here, for instance. That could be one too, indeed. It is less of a sideways zone, perhaps because there's a higher high here. But, I mean, depending on what price action was before that, one could argue for that. Someone mentioned, for instance, here that there was supply, right? And considering the fact that price went up there and faced a fierce rejection and a turnaround, a bearish turnaround, one could kind of view it that way. But what I consider personally when price moves up to that level is that it wasn't able to break through a resistance level, all right? In the past, there could have been somewhere a demand zone, I don't know, a supply-demand zone in the left. But when price moves up like this and quickly moves down, the terminology I use, at least for that, is that it's basically bouncing at resistance. So, words are maybe less important. It's just everyone has their own way of, communicating what's going on in the chart. I would call this a bearish bounce, and I would call this a supply-demand zone. All right, so that you have an idea. This is what we're going to roll with at least my part of the webinar. So let's define that a bit better. Let's discuss some of these parameters and characteristics, what I call a supply-demand zone, and that could vary from trader to trader and from video to video. but this is what I am used to, and this is how I define it. So first of all is momentum is required. So that's indicated by this green arrow. All right, that's the first thing. I need to see a bearish or bullish momentum, and then I need to see, second of all, that sideways zone, indicating price is not able to break lower or higher, and it's basically going flat. Its range is also another way of saying that. Now, something like this length is pretty good. I like it. There are probably going to be about 24 candles in this. Supply-demand zones that are smaller, let's say 5, 6 candles, are really just retracements or pauses in my opinion, maybe small triangles. They could be supply-demand zones on the lower time frame, because those 5 to 6 candles on the lower time frame could be roughly like this, 24 perhaps. So anything that is, accumulating to something like this size is ideal, in my opinion. If it's much longer, then it starts to become almost too extensive in time. So anything I would say from 14 up to 30 is just a rough estimate of what I probably would say is ideal. More than that, it could take too long, and it could collapse under its own weight. As it stretches and stretches sideways, it might not make the break with the momentum. The momentum is up, so when you get a sideways zone, the standard expectation is that it would continue up as well. One of the rules I like to see is that price is not breaking the 23.6 fib. If it is, and it's going down to 38.2 fib or to 50, typically then I'm looking at a bull flag or bear flag. If that happens, this low will get broken, and basically price will be building something like this with lower lows and lower highs, and that typically is some kind of corrective flag like that, and those will respect mostly the 38, sometimes the 50 fib. All right, so I want to see the 23.6 respected, and I want to see then the break of that, either the bounce here or the break as momentum continues with the previous momentum. All right, so those are basically, this is an ideal situation where we have momentum, sideways momentum. So with these characteristics, these items in mind, when looking at this particular pattern, basically, I have the following two ways I'm trading it. So let's take a look at the first one. The first one is trading basically within this zone as the zone is being built, and it basically goes sideways. That's the first way of trying to trade and position myself within that zone before it breaks out. All right. I guess method 1A would be the breakout itself, but I didn't want to talk about the breakout because breakouts are, again, a different topic, really, are a different webinar. We've had already breakout webinars in the past. You can look at YouTube channel from Admiral Markets. Just go to youtube.com, click Admiral Markets search, and you'll find the YouTube channel. And basically, we discussed that already. So within this method 1, this is a live example from last week, actually, from the Euro-Dollar 1 hour chart. And this is a discussion that was held on Tuesday. And this was live. And what I said live was that at this point, I was actually expecting price to retrace. Right here where I have the green arrow, I was expecting price to retrace down to the 38.2 fib or 50. And I was interested in buying it at the retracement for a long, for the target at the fib levels up in here. But I said, if price doesn't get down to the fibs and it bounces, because the live webinar was actually around here, roughly, I think, somewhere around here. So at this moment, it seemed quite likely, because there were bearish candles here, that it could push a few more pips lower to these fibs. But I said, if it doesn't, as a backup, I said, if it doesn't, what I'm looking for is price not to break the 23.6. I want to see price bouncing basically off roughly the same level here. When we have two bottoms like this, in that case, the next time it approaches it, there's a good sturdy chance that price will actually use that for a third bounce, and that could be the rally up. In fact, there was another one, a fourth bounce right there. And once you get two bounces at the same level, the likelihood of a deeper correction becomes to decrease quickly, because what you typically look at is either like an ABC correction like this, a three-wave correction like this I show in red here like this, that entails that the second one basically breaks the first bottom. So if it doesn't, and the second one respects the first bottom, there is a good chance that the third one will get the bounce. All right, waiting for some candlestick pattern like this, engulfing twins would be the last kind of confirmation needed. And the fourth one had an engulfing twin as well. So that candlestick pattern, at the third or fourth bounce is exactly the confirmation needed after price is consolidating and showing that consolidation with this second bounce. All right, so is that clear so far? This was a live one, once again, so not something that, was cherry-picked or something like that in retrospect, but was discussed in the live trading room last week. If you have any questions, let me know in the chat. The stop loss goes below the bottoms or the 38.2 fib. Both are equally valid, really. One is beneficial in the sense that you have a tighter stop loss by going below the bottom. If you go below the 38.2 fib, then even if it turns into a bull flag, then you're still relatively safe. The thing is, there is, in this case, it's a perfect example of the third and fourth. If you use, I would say it depends on how a trader takes the entry. If it's a pending order here at this level because you're expecting the third bounce, I would go with a wider stop loss because this could still turn into a bull flag, especially here because there was a lower low here slightly. So in that case, I would be more inclined to use the 38, the purple box, as a stop loss. If I'm manually trading it and looking for market orders and I see and wait for this engulfing twin, then I would be more inclined to use the bottom instead, especially with the next bounce here, which is looking a bit stronger. This engulfing twin ultimately looks a bit more robust than this one, doesn't it? Actually, this one, the first one, is not really engulfing twins because the second one is not big enough. So yes, so the second one, definitely the tighter stop loss at the black box there is looking better. Take profits, I'm looking at fib levels basically. I would put a fib as I did here from bottom to the top and wait for 272 target or the minus 61.8 target to get hit. All right. So now the second method is basically looking at a different pattern or formation, but you can basically use the same kind of idea regarding supply and demand zone with abnormal gravity indicator. That's part of the MT4 Supreme Edition. All right, that is one of 100 features that are available through Supreme. It's a free download, all right, and you can test it with a demo at first, and it's free for live account holders, of course, as well. So test it with your demo, and you can see all the advantages. One of these is the abnormal gravity indicator, and it basically indicates something like a supply-demand zone. It's a bit different, but the idea behind it is not too much different. They are similar in their concepts and goals. It basically shows where we can expect kind of more activity, where is price more engaged, at what levels is it more active, and what levels are there more spaces. So darker blue indicates more basically robust movement. There is more expected activity, whereas light gray, basically price can kind of is expected to move through that area with more impulse. There's less standing in the way. So it's not the same exactly, but the advantage is that it's automated, so the indicator is there. We don't have to look at it ourselves, draw the boxes ourselves. It is automated, so that saves us time as analysts and makes things just simpler. So that's one big advantage. So if you find that interesting, I wanted to tell you about the gravity because I thought that they had a connection here with supply and demand. So just wanted to give you a heads up that this is available, plus a lot of more other things that we mention more often. So if you join our webinars regularly, then you've heard of the alarm manager, you've heard of the sentiment trader, the correlation tools, and free drawing and alarm manager, and many more. So take a look at that. Very, very useful. All right. So regarding the second method, great to hear that, Bernard. I'm happy that you'll try it out. I think you have to see, I mean, there are a lot of features, so I think probably not everyone is going to like each and every feature. Obviously, there are too many, but I'm sure that if you go through the list, you'll find the ones that are most beneficial for you. All right, so the second method is basically now looking at the supply-demand zone. So the first one was trading in it as it kind of develops. The second one is trading it after it's finished, if you see what I mean. So basically, when the supply-demand zone was developing, I talked about these two setups right there. But as price breaks out, right, okay, we had a breakout potential right there. That's a different webinar, right? There could have been perhaps even some reversal potential here. That's a different webinar again. That's a reversal trading webinar. But the second supply-demand zone method would be for price to go back to that. So that is right here. That is the green circle right here. That's when price returns to that supply-demand zone after moving away from it. So that's the second method. Basically, once price does that, a bounce is expected. So once price returns back to this same zone, there's a good chance price is going to bounce. Not always. Sometimes price goes through it, crashes right through it, and these patterns sometimes do not uphold. You got to be aware of that, obviously, right? It depends. I mean, I'm a wave analyst, so for me, it depends on the market structure, whether I think a supply-demand zone will hold or not. If I think that this is a wave 4 or 5 and makes a wave 3 of a larger degree, then I do think that there's a good chance there will be a bounce here. All right, so that's what I do. But waves are a separate story. All right, let's talk about this strategy as a standalone stuff for a moment. So a bounce is expected. All right, so let's talk about that in more detail. All right, so basically the entry is in that zone. Anywhere where that supply-demand zone is, the bounce could happen. So the entry needs to be in that zone. Once again, a pending order can be placed, or I'm waiting for a confirmation. All right, one of the two. Stop loss has to be below that zone in a buy, right? Has to go below it. And the TP could either be at the candle lows here at the green box, or at the tops here in this case at the purple box, or even the fib levels if you're confident that the price is going to make a higher high. But the idea at first is a safe trade. A safe trade in the sense that we want to get the profit before the market really has to prove that the trend is continuing. So that's why the take profits are aiming at relatively close resistance levels, because in case the market makes a bigger correction like it does here with one more lower low, reversing basically, the idea is to get out of the trade. So it doesn't count necessarily on trend continuation as a kind of default way. I mean, it's possible by using discretionary analysis and saying, okay, this time the market looks in such a way that I think, according to my analysis, that there's a good chance price will break the top, right? And great, nothing against that. But because it's a bounce trade, the primary idea basically is to aim for something more solid and more sure by aiming at the most closest resistance, or of course support with shorts, the opposite. So let's take a look at this in more detail. So in general, a 2-to-1 reward to risk is okay. 3-to-1 is better. A 1-to-1 I would not consider sufficient. So with these ratios in mind, we can calculate where the entry and targets could be. We know where the targets are should be. We know where the stop loss should be. We know what reward to risk ratio there should be. So with those things fixed, we can calculate the entry. We can do that as follows. In this example, the stop loss should be below the supply demand zone. So that's going to be around 112.23. The TP, the conservative TP, is going to be aiming at these candle lows, right? The more aggressive one will be at the highs. So with a more conservative one in mind, it's 112.78. That's a 55 pip space, basically measuring from stop loss to take profit. So the distance from the stop loss to the take profit is 55 pips. Now, when we look at the ratio of 2 to 1, all right, that's 3 units. So we can divide 55 pips by 3. That's roughly 18. A bit more, 18.3, but it's roughly 18. That means that 1 unit of risk is 18 pips, and 2 units of reward is 2 times 18 is 36, or 37 if we round it up for the target. So that means our target is 37 pips, and our stop loss is 18 pips. With a stop loss at 112.23, we can add 18 pips to that, and we would basically arrive or derive to a entry of 112.41. That could be a pending. It could be this is a pending example actually, so let's stick to a pending for the moment. It could also be a confirmation signal, right? When we get a bullish candlestick pattern here, but that changes the equation because the stop loss could be basically below the candlestick pattern low, and that probably will have a 3 to 1 R2R in this case, right here. All right, but that's a different equation. Let me finish this one first. So the entry, the pending order at 112.41 with a 2 to 1 ratio. If it's a 3 to 1 ratio that we're aiming for, it would probably be not, the order would not have been filled in, right? Now it just barely got filled in. Look at the pink line. It just barely got touched, and the TP just barely got touched. So this was really a close call. It would have been just a tad something different, and would have been a loss or no trade at all. But it did profit. This was a profit, but it was a close one. With a 3 to 1 target, I don't think we would have entered here because the space is small. 55 pips divided by 4 is 16. No, it's 14 pips. So yeah, that would not have been the entry there. All right, so that's basically using 2 to 1. If we aim for 3 to 1, of course, we could aim obviously somewhere up in here. That could have been a second take profit right there, and the first one would have been here. Half the trade could have been profit. The second, maybe not, if we split it, right? All right, if the bounce has happened, all right, then, and I'm not taking in, I'm not going to wait for the second bounce. Like here, for instance, you see the bounce happened. If that bounce has happened and price is somewhere in here, I'm not waiting for price to get back to that same zone, because if it does, it could be just a bigger correction. So I canceled the order. In my humble opinion, the way I look at supply-demand zones, there are not going to be a ton of them. But it is useful to keep in mind. It is, I think, useful to know it, because if you're doing discretionary analysis, then occasionally you're going to see it on all time frames. But it's not something that is raining from the sky. It's not that often either. Maybe if you use a bit more different way of looking at supply demand zone, it could be more frequent. But this particular structure or pattern that I just mentioned is not something that is, that you'll see 20 times a day. All right, I think that from my perspective, sideways zones, the sideways zone, and the context is key. So as long as there's a decent sideways zone and looking at the market structure, everything still seems good, then it should be a pretty decent chance of a bounce. So looking at this is a pound dollar 4-hour chart. This is not a supply demand zone. This is a bottom. If price would have broken to the downside here and then hooked up, yeah, that would have been the supply demand zone for more downside. One more thing, by the way, I should mention, I forgot to add here, I just realized it now, is that also important is the speed of the second impulse. All right, so here we have the first impulse. and this is the second impulse, right? If the speed of the second one is not that large, and you see a pretty substantial difference between the first, the second one is pretty much smaller than the first momentum, then it is good to count on the fact that there might not be a strong bounce when it returns. So in this case, aiming for the shorter target makes sense because of this relatively small push here. That increases the chance of a larger bearish correction. Therefore, it might also be better to use actually a candlestick confirmation. Wait for these candles to arrive like this. For instance, as a candlestick confirmation, take the order there, put the stop loss here, and aim for the same 2-to-1. Hopefully, I think that would be 2-to-1. So the bigger the momentum, the better. So if this, for instance, this zone right here would have gotten a break to the downside and then hooks back like this, then that's a supply-demand zone for a bounce back to retest this bottom. So the trade is from here down to roughly here as it tests this bottom right there. All right? It didn't happen though. It broke to the upside. So this is not a supply-demand zone because it's a bottom. All right? That's a bottom. Triple bottom. On the lower time frame, you see triple bottom. Here, 1, 2, 3. But something else might be a supply-demand zone. But you see there's not a ton of them, right? Because the market is quite choppy, and you need a good momentum before you can have that. All right, so there are not a lot of them here, but we'll find something. Sorry. Let's see. We had one. Perhaps here one could say that's not a great one though. We had one here, a small one, but these are small ones, and these are more on the hourly chart because this is a 4-hour chart, and there are only a couple of candles. As I said, I like 13 to 30 is ideal, and these are relatively small. So these will probably be more 1-hour zones than 4-hour. All right, but they could be potentially 1 hour. Right in here, that's also more of a 1 hour. In this chart, I don't really see a 4-hour one, just to give you an indication. All right, but gravity here is still on the chart, as you can see. All right, so that was basically what I prepared. We can take a look quickly. I still got a couple of minutes left here at what the charts are saying right now. We can take a look and see if something is available. We'll take a look at, this was the pound. Let's take a look at the dollar again. We looked at the euro dollar in the first example, then the pound, and we can take a look at the dollar yen now, see if there's anything available. Any questions, by the way? Please let me know through the chat, all right, if you do. So we can start from monthly, why not? Just dive in here and, well, I would say from a weekly there was one, but it's been broken already actually. There was one right here. Right, and we got a break of that low, as you can see. So that was one, but it was invalidated. However, I still think from a dollar yen perspective, it's bouncing at that 50 fib, in fact. So, you know, from that perspective, I think still it could be in a bouncing spot. We'll have to see. If it breaks the 100 level, then I think that there could be a bearish breakout. For the moment, though, it's respecting 50. I think it still could be a bullish bouncing spot. You know, on a weekly chart, supply-demand zone like this as well, we have to realize that they, of course, are more rougher in size and area, perhaps because it's such a big time frame, right? So even though, for instance, price broke through this 50 fib by a bit right here, sorry, here, it's still respecting the 50 fib. On the weekly, there was an intra-week push below it of 100 pips or more. But from a weekly chart, 100 pips break actually is nothing because it's still respecting the 50 fib. Look, a big wick here and no break of that 50 fib. So, you know, these breaks are all relative on time frames as well. Despite the push here, it is forming a double bottom at 50 fib for the moment, unless it pushes through that. So, but that is an example, although there was a slight invalidation of that. So let's take a look at the daily. All right, here there's a good example. I'm not sure if the 23.6 fib is respected though. It's actually went back to the 38. But after that, this particular zone did respect the 23.6 fib here. So I think that particular part still qualifies. And price went back into that zone, as you can see, and moved away from that. So that was a good bounce right there. Also, the first setup, right? This is the second setup. The first setup, right? 1, 2, all right? And here's the third and the fourth bounce. So here and here, those were good setups for the first method as well, where I have the red circles. So those are examples of the two different ways of trading supply demand. So right there, A and B. Anything else on this daily chart? Let's see. Well, ironically, this is a small one here, but it did have momentum prior to it and after. And when price went back into that zone, we did get a bounce. All right, we did get a bounce, but then price wasn't able to break through. That's why the target is aiming at these resistance spots, aiming at these candle lows, so that if it fails to go for a higher high like this, profit is still made. Ron is great, Ron. Thanks. Excellent. Let's take a look on the daily, I guess, 2nd of August. Second of August, let's see here. And the 26th of August. Yeah, this indeed, although price broke to the opposite direction. So if it had broke down, indeed, but now it was kind of turned to the opposite, so it was a turnaround in fact. But despite that, I'm not saying it couldn't be support. Obviously, there's a trend line. Obviously, there are tops and bottoms. It could still be support, but it's not. Oh, 4-hour chart. Okay, that's something different. Let's take a look. Yeah, we do have momentum here, and then price going sideways like this. Now, the momentum is a bit small. I like to see price respecting the 23.6 fib, and here it retraced pretty deep. So, from that point of view, it's not a perfect example, but this is actually great that we're looking at this one because we'll have many occasions when they're not perfect examples, in fact. That's why I said this is like the school board example, but that means also that it's more demanding and more criteria, so it's going to happen a little bit less often. We'll see more of those actually in real life as well. And yeah, it's still useful. It's still useful information. Maybe if we look at it differently, for instance, let's see, is there any way perhaps on an hourly, maybe here, this zone, could it be supply and demand zone? Let's see. Here, that zone right there, I think could qualify, or this zone here could qualify. And as you can see, price gets into that zone here, right? Here it's where it enters, all right? And it doesn't always have to go very far, right, before it basically turns around. All right, folks, my battery is low. I'm going to pass it over to Nenet. Make sure that my PC does not collapse here. Let me pull it over to Nenet. And if you have any questions, of course, feel free to use the chat box.
Thanks, Chris. So today I will show you two strategies also, but those are not fully developed strategies. So those are just designs that maybe you can use in your trading. And one of those has been based on our indicator that I have shared with you, I think in last 2 months, I sent a lot of this indicator to a lot of people. So I think that you should have it. It's supply and demand indicator. And the next one is based also on supply and demand, but we will use 2 additional moving average. As you know, I am a fan of Camarilla and my own zones, and points of confluence will be, of course, one of our future classes in price action trading school. And before I start with the supply and demand systems, I need to show you the exact spot where we actually had a trade today on dollar yen, and that is also a form of supply and demand, of course, because all POC zones have confluence points. Those are confluence zones, and that is exactly the zone where we buy and sell. So you don't need to ask me what is a POC zone. That is the place, guys, where we buy or sell. So this was the analysis for dollar yen here, and I was very specific. If price gets here from this spot, it should be bought. And what happened is the price went a little bit below that, but just a little bit below that, and it was bought heavily. Really, it was bought heavily. It was like 70 pip rejection. Now I will just use this chart to show you that confluence spot, and here this is what happened after I posted the analysis. So this was the candle here, and just 1 hour after, or 1 hour and a half, the price dropped. But watch the price movement. This is important. Watch the price movement, guys. You see, this is what I'm talking about, and this is the core of price action. So I don't know if it will be bought next time again. That is why I always say that is also a part of supply and demand. Usually the first rejection is the strongest, and that is why historical buyers are aligned with now moment buyers. And here you see I put these lines here intentionally because this was supply and demand. This was actually where the price was bought. Watch this, guys. Watch how it rejected. So it's not a coincidence. That is what I've been teaching you guys. That is what we have covered in our first lesson. Use these wicks and use the bottom of these bodies here. You don't need to be precise to the pip. It's not important. You know, you need to give price a breathing room, as always. But just try to imagine that in your head also. Try to actually visualize why the zone is that strong. It's not just chart and put here. So here you see exactly here. Watch this. Watch this here. From here, here. Watch this body. Watch this candle. It goes to the trend line. So you need to. It cannot be so automated. That is why I'm saying always those zones which you chart are much better than indicator zones. This is easy, guys, here. You see, these are zones. And now if you go to supply demand, you will see here, top color, bottom color, you can change the color. It has a good logic. Here you see it's good. It's not bad. It's a good logic. But it's much more accurate when you do it by yourself. See a trend line, then here we have the zone, and we have a lot of confluence here. So if you bought the pair anywhere from 102.606 to 17, maybe you went lower in a trade. Here, the price spiked to H3 pivot point. It's actually our daily pivot point on Camarilla. You could have made tons of pips for just 1 hour of trading. See? So that is what I'm saying. You need to know, and we will go through this. We will go through all of these things, all this stuff. Of course, we will, as I say, we will do also live trading after we finish with price action in trading school. Instead of once in 2 weeks on Wednesdays, we will try to go with that live trading. So I hope that there will be setups, but if we don't have a setup during the live session, well, that will be valid also, because it will be a swing method, right? So just stay tuned and we will do that. But as far as supply and demand, here a good question Ron is asking, do you use also trend lines based on a line chart? So you don't use the wicks? No, Ron. I always use wicks, and I don't like line charts. Simply I don't know how to read price a lot with line charts, because I am one of the first books that I have read was also Steve Nissen's Candlesticks, and I have learned a lot about candlesticks, and I simply, you know, also T89 pattern, that is my own invention, T89. And now if you let's just take a look at T89. I will open my my template Camarilla, and I will show you. This is analysis template, and I will show you now T89. And here, guys, you see dollar yen. Wait, where is dollar yen now? And T89, I cannot see that if I use a line chart. I simply cannot use it. So look at this, double T89 here. Yes, it's not possible with line chart, Ron, indeed. And watch this, T89 here, T89 here, you see? But I didn't use it to enter the market. I just said this was the part of my analysis. If you read the analysis again, I said additionally we have 2 T89s. And what happened is price rejected. So here, this was the candle, and then it dropped off and spiked up. So you need to understand just the principle behind charting. So this is very important. You need to see this. So for first part is very interesting for you. You should be able to draw these zones, at least those basic zones, pretty much easily, manually. If you don't know how to do it, just zoom a little bit out and let's find it. So you can always use previous price action. So watch this here, and of course here. You should have touches. Do you have touches here? You have 1, 2, 3. So the first line is great. Second line, 1, 2. A lot of selling here. You see buying from the zone. So this is pretty much straightforward. Line here, line there, aligned with historical buyers. So you see, you need to align now moment with historical moment. So always pay attention to the past. Always, guys. You cannot just trade the present when you make trading decisions. I know that sometimes maybe it's hard for you to enter just with price, because it's a logic of human mind. It's human behavior, and you can learn about it in human behavior analysis. People always want to do something easier, right? And it's okay. I mean, it's the law of human nature. But when you master price action, you will see that it's not that hard, and you will have more confidence to place trades within these zones when you see a confluence. not always by using additional tools for entry such as MACD or maybe stochastics or CCI. But here, when you master this, you will be able to do that yourself. So once more, open your template. Any pair, it doesn't matter which pair, it simply doesn't matter. So let's see now moment and historical moment. So here, where would I put a line? Here, so we don't know what happened actually, okay, let's see. This is where I would place the line. At least it has some history in it, near-term history, so this is it, okay? This candle, because it has the nearest history. What happened is, you see, it's not the perfect touch, but actually this is where the price rejected. One maybe pip from the zone, you see? So always try to align it. It's important. Watch this. It's so obvious. Watch this. Here and there. And just see if there was a history. Let's say we don't know if there is a history here. Let's roll to the left. Huh? Do you see that? That is why I'm saying Forex trading is great, because it gives you possibility to compare now moment with historical moment. And this is what I like to see. Watch this. You see? Here, probably somewhere else. Watch this, how these wicks actually are touching the bodies here. Always almost perfect rejection. A lot of history on 1 hour chart. That is how you do it. Try to chart it, include it in your own systems or methods. Why not? It will help you. So let's say here, now moment, I would place a possible sell maybe here next time, because you have a lot of history and now moment. So this is, let's say, now moment. This is history. Let's see if there was maybe some more history. Look at this, almost there. So you just need to watch if there was a historical moment. Here we had a history, there. So those are your lines. Those are the lines where price will reject. Here also, probably if we see a history. If we don't see a history, we move on. We won't do anything without a history, guys. We simply won't do, yeah, here, there is history. So this, what, you could have sold it here. See? I always say 15 pips usually we go from POC for rejection. But I cannot say that there is a strict number. It cannot be 20, 30 pips because it would be too much. But usually something in between, let's say 5 to 10, maybe 15 pips, that is what you should do. So if I say the zone is 32, 35, 32, 25. So if it goes to 32, 20, it's good. If it spikes to 32, 40, it's good. It depends on the time frame, but usually on 1 hour, 5 to 10 pips is good. And you don't need to worry, because if you're wrong, what I teach you guys, always lower your risk. That means if you want to trade with 1% of risk per trade, for example, your first trade should be, your first entry should be 0.5% of a risk. So if you want, if you think and if you wait maybe for the price to go more to the upside, to exactly touch the zone or hit the zone, then you can add another 0.5%. It's easy. I want you to understand that. So if you want to trade with 0.5 lots, with a stop loss that is enough to give you 1% of risk. So instead of opening 0.5 on the first trade, open 0.25 and add 0.25 if it goes in the zone, directly in the zone. Because sometimes the price will probably go very close to the zone, as I say, 5, 10 pips and then reject. But it's the zone, so you can surpass a market behavior by adding into your trade. It's not adding into losing trade. Remember that adding into losing trade is when you don't have a stop loss and you actually adding to a trade that is losing. But adding into retracement, it's another thing. Okay, it's another thing, adding into retracement. So as I'm saying, this is not a trading system. This is not that, but this can help you in your trading decisions. And this should help you in your trading decisions. Always. Let's use one more example. Why did the price reject it from this zone? Why? Because here, watch these guys and remember, I want you to dream about these things. That is when you get it into your head so heavily that you actually know what I'm talking about. I mean, for me, this is better than indicators that show supply and demand. This is no brainer here. What is this? This is head and shoulders. Right shoulder corresponds to left shoulder. Right shoulder is now moment, left shoulder is history. Is there a history in the past? Yes, it was. Here. That is not hard, really. So observe the price, add into your position, try to demo trade, try to demo practice those zones, not the system, the zone. So you will see when the price is close to potential zone, it can go 5-10 pips close to it and then reject. But sometimes it will get straight into the zone. We don't know that. We can just assume it will. For example, dollar-yen trade went a little bit deeper than my zone was. Sometimes it will be a little bit higher. But that is why we can scale out. That is why we can trade with lower risk. So we can add into position. Focus on pips, not just the money, guys. You actually know that trading is not to make millions overnight. Unless you're trading with huge money, but then you don't need MT4 platform, right? Maybe just for charting, not for trading. So when I traded with bigger money, with 150K, 200K, actually we traded also price action most of the time, coupled with some indicators, not naked trading. Yeah, billion, as Darshan is saying. Billions is actually easy to trade, guys, but people who have billions wouldn't like that, what I'm saying. When people ask me, can you trade without a stop loss? I say yes. If you have $1 million, then you just open one lot and you don't need a stop loss, right? And you still will be always positive, because with $1 million, open one lot and why? You just wait. But you know, when you trade with millions, the return of investment is not that high to justify for that period. So you will have money, but not a good return of investment, right? So you will always want for more. But that is the fact. You cannot lose with one lot on 1 million account. That's funny, but that's true. So that was it. So chart these zones as candlesticks and always use now moment. So if this is now moment here, which indeed it is, we can expect the price to react here and try to contemplate it into a maybe a scalping strategy. So if you know that this could be a rejection point, zoom into 5 minutes and try to scalp. So this is an interesting idea for you. Another thing that I wanted to show you is, this is second one. So our supply demand indicator. So I have added here an EMA that corresponds to 25 exponential close. So once price hits the zone and it breaks through DMA, that could be a signal for sell. So I'm not saying, again guys, I'm not saying that this is a trading system, but these are trading ideas that you can incorporate into your own strategy instead. So watch this, how the price behaves. So it hit the zone, and what happened actually, it rejected. So that is the point. Try to imagine that the price is actually following those supply and demand levels exactly as the price follows historical versus now moment. Although I say again, I like to draw it myself. Maybe I'm a little bit of old school, but that is what I really do, to do it myself. But still, I think that you can use this indicator for a couple of interesting strategies. And don't forget that you can always try to incorporate into some into MACD or EMA or Bollinger Band and so on. So it should not be that hard. Okay? So here you see price hit a supply, it went down and then it dropped. Hit a supply, went down through EMA and dropped. So try to mix this into your own strategies, or watch it how it behaves. Maybe you could have think of something. Here the price hit here, rejected, went for some 6-7 pips, and now it's rejecting it, you see. So now, because it's end of day, this is your, you see, this is your supply, this is your demand, so the range is a bit tight now. But actually you can see how the price behaves. So what we could maybe assume is, because the price here is making higher highs and higher lows, this supply zone will be broken and the price will proceed to next supply zone, right? Because it was rejected through here, this is now a mini supply and it could go to this major supply here. Okay, so this was it, you see. Not that hard. Yeah, questions? Just let me show you a new one, and I will open. I will answer questions. Aha, good. Ooh, some questions. Okay, guys. And this one, this is also you need this indicator. So if you don't have it, I will provide you support resistance lines. It's actually supply and demand also by indicator. And the point of this possible strategy is you have two EMAs, 30 and 50. When 30 is above 50, we can say that it's an uptrend. When 50 is above 30, we can say it's a downtrend. So once hits, when price hits a demand, while moving averages indicate a uptrend, you wait for stochastic cross of from below 20 to above 20, and CCI also to be slightly above -100 or just below -100, and you can actually place your trade. So you see, it's actually straightforward. So these are the zones. This is stochastic. You see, it's working good on this couple of examples here. You see how it behaves. When there is a change of trend, you will usually see that. When there is a big trend, then this can work really pretty much good. You see, zone here, stochastic signal, and CCI, and it goes down. So you can actually try to experiment with it. Now the questions, if you need this, guys, just tell me and I will send the indicators. I mean, you just need that supply and demand, or SR lines. The first question, Nenad, are you back from holiday? Yes. Darshan is saying that he heard that in London they have a super summer right now. Yeah, I'm back full time. So, thanks. Agnes is saying, Nenad, could you take a look at Australian dollar New Zealand? Australian dollar New Zealand, yes, is at bounce. I was watching Australian dollar New Zealand today, and actually, yes, it is a bounce. On weekly, possibly yes, because here in the history we had a bounce, strong. So it could be a bounce. On 1 hour it is here, you see? So the price is making higher highs and higher lows. You see on weekly, on Australian, New Zealand, this is the zone here. So roughly it's 0.383. So 0.383. Sorry, not correct. I need to zoom in for this. Give me a second. I need to zoom in. So here actually. From this spot, see this candle here, okay, 73, and the low of the candle is 34. So 73 to 34, you see? And watch the history. Same one. Same one. See? So yeah, that is it. And this what happened. You see how the price is respecting weekly demand. Bogumil is asking, what about Lai's price action training school? Yes, it will be uploaded. I probably forgot to upload it because I went to, yes, I went to, I was in Frankfurt yesterday all day, one IB day, so I will upload it as when I finish with this lesson. So Egils, you can also, Egils is asking, can I apply this knowledge? Yes, always apply this. So if this weekly candle, especially if it closes like this, you know that you can buy within this region. Darshan, yes, that was it. Australian dollar, New Zealand. You see, it's going, I think it might go up, really, from this zone. It's still within the zone, so it could go up. So that was it, guys. If you need indicators, tell me, send me an email. I will upload a previous lesson on price action training school. I hope that you enjoyed it. We had a good session recap. Don't forget, we made good money with the euro dollar, with pound dollar, and maybe some other pairs. I didn't check it. I didn't have the time also to trade because I was in Frankfurt. And today, dollar yen, so-called ninja, perfect rejection from POC. So I hope that I will see you again. Thanks for your questions. Thanks for comments, guys. And try to incorporate some of this. Maybe it will help you. We will talk to you soon. Cheers, guys. Trade safe.